Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everybody. I see people logging in. Good to see everybody. Another beautiful Tuesday. So happy Tuesday, everybody. We've got quite a bit to talk about again today. So I'm just going to wait a moment for people to log in. And I just want to thank everybody again. Our list continues to grow every week. And in fact, we took a bit of a moratorium on accepting new clients for a couple months. I didn't mention it before, but pretty much all May, June, and so I'm thankful for that. But we just want to make sure that we're doing what we should be doing for our existing clients as well. So all's good at Attleboro Wealth Management. This past year has been surprisingly amazing for us, and it really has to do with having these discussions via webinar, which was really just accidental because I wanted to stay in contact with all my clients during the downturn we had last year, and it really turned into these great opportunities for educational events. And I do get some feedback from people, so I appreciate your feedback. If there's something you'd like me to talk about, send me that information. If there's something that you feel as though deserves more time, maybe we can do a special webinar. And I've got those that I've been talking about scheduled now. I'm going to talk about that during this webinar today. We want to make sure that there's a good balance of new material. And what I've found over the past year is that also the repeat of these strategies is very helpful. For instance, today we're going to talk about life insurance, using life insurance in your tax efficient financial plan or any financial plan. And what I've heard repeatedly from clients is that these concepts repeated from time to time. And I keep all of my notes from my webinar so I can go through and look at content. So these concepts repeated from time to time help in reinforcing what we're doing with your plan, because we throw a lot of information at you, and I understand that. And we've tried to ease it by breaking it down over that 8-week period, 4 appointments. So because I remember when I first got my CFP certification and started, even really before that, started down this road of really digging into financial planning. I had a client that I tried to do everything. I just tried to bring everything into one meeting, and she said, "Stop! I can't take it anymore." And thankfully, we had that kind of relationship where she could tell me that. And then I created a 6-month program, and I found quickly that was too long because people they lose momentum. And momentum is very important because things can get in the way, and also things can happen within that 6 months. So that 8 weeks seems to be really a really good time because it's not too crammed in. It gives us time to get the work done on both sides in between the meetings, and it keeps that momentum going. But that said, it's a lot of information. People come away from the meeting saying, "I completely understand that," and then a couple of weeks later, they'll say, "Well, wait a minute, what was that concept again?" And there's a lot of books I use for reference today. I'm going to use this Look Before You Lerp book from David McKnight. If you don't have this, I have maybe, I'm looking at my shelf, maybe 6 copies left. I can send you a copy. My caveat is, if I send you a book, I'm happy to share my books. You just please promise me that you're going to read them, because there's nothing worse than spending the money on the book and the shipping, which I'm happy to do, and then have it not be read. So anyway, the repeating of the concepts, I think, is very good, and having these reference manuals or books around is also very helpful. So let's get started. It's 10:03. And today is May 25th, as I think I said, and just want to remind you that you are all muted. There's a Q&A available at the bottom of the screen. Your chat is disabled, and of course, these videos are recorded. And I was just talking to my 19-year-old son, who's helping me now with my videos. He's doing a fantastic job, and he says he's got about 90% maybe he said 95% of them edited and up on the YouTube channel. So now it is just choosing the top 6 that we want to use and putting them through compliance first, and then doing the other probably 100 videos and getting those done over time. It's probably going to take us a solid 6 months to get all these weekly webinars up onto the website, but we want to get the key ones, the Ed Slott discussion, the David McKnight interviews that we've done. Steve Bobrin is very popular, the Medicare fellow, and Brian Adler, the attorney, the elder law and estate attorney. So we want to have these up. I think they'll be my top 6. But if there's one that you've attended and you said, Mark, I'd really like to see that again, let me know. And once these are all set up on the website, of course, you can go there. And then if you have other ones that you want to see, we can shoot the email out to you. And the plan is that each Tuesday, it's going to be much easier to keep on top of these as they're edited, because he edits new ones really by the end of the day on Tuesday. And then once they're through compliance, which is not a small process, we can send that out for view. I do hear from a lot of people. We've got over, I'd say 100 and some people who register on a regular basis for this Tuesday morning webinar, but not everybody can watch a Tuesday morning webinar. So I think it'll be helpful, for those who are still working to be able to watch it. We will be out of the office. I will be out of the office this Thursday and Friday of this week. The office will close at 3 on Friday. So my staff will still be on Thursday and Friday. I will be out of the office Thursday and Friday, just letting you know. And we're, of course, closed on Monday in observance of Memorial Day. And this Friday kicks off our summer hours. So we'll be closing at 3 o'clock on Fridays, unless, of course, there's something that needs to be done to take care of client needs. And it looks like the plan is to return to the office, physically in the office on a regular basis beginning in July for the staff. Now, I have found that these webinars for Zoom meetings for clients are very, very efficient. So I will continue to do those as much as possible. But if a client wants to meet in person, we'll certainly do that. Okay, so here's the upcoming special webinars, and you'll get an email about this, but this is the schedule. So the first one will be funding using annuities and retirement planning and Roth conversions. I had a lot of requests when I talked about that in a webinar to schedule that as a special Wednesday evening webinar, where I'll just talk about that for an hour and a half or so. And that's going to be the evening of June 9th. Just checking my calendar as we're talking, and these will all start at 6:30. The second one will be a fiduciary assistance for powers of attorney, trustees, and executors. So this is a big topic, and one that I've told you that I've taught to attorneys through continuing legal education classes, and one that comes up often with existing clients. So from time to time, I still have attorneys contact me and say, Mark, I have a client who is a power of attorney, who's a trustee, and they need help. Or an attorney will contact me and say, I am the power of attorney or trustee for this trust, and they want to follow the fiduciary guidelines that are set forth by FI 360, which is this global, fiduciary process. And I help people walk through that. So it's very, very important to understand what your requirements are, what you have to do acting as a fiduciary, because if you are a power of attorney, trustee, or an executor, you are acting as a fiduciary, and what the rules and regulations and laws and processes should be for that. So that's a juicy topic. We're going to, on the third webinar, the third Wednesday, we're going to talk about investment fundamentals. So what are mutual funds, ETFs, exchange traded funds, individual stocks, bonds, how they all work in a portfolio, the pros and cons. And that'll be July 21st. And on July 28th, so we're going to do 4 webinars in 2 months. July 28th is the reality of the 4% rule. So you've probably all heard about the 4% rule. I've talked about it a lot. I think my feelings about the 4% rule, it's just complete bunk in my opinion. Those rules of thumb you should never really use, and it's very individualized for everybody. Many people spend much more in the first few years of retirement, and it reduces over time. What we want to avoid is the opposite of that, right? Lower expenses during the beginning of retirement and then increasing over time, if at all possible, because that often leads to a accelerated drawdown of your assets, and that's no good. So we're going to spend time with the reality of that 4% rule, how it was started, what it really means, and really how a withdrawal percentage applies to an individual plan. And we're really focusing on individual plan, not the masses, right? The problem with the Susie Ormans and the other, financial gurus, they're out there to sell TV time or books and trying to educate the masses. And when you throw out something like a 4% rule, you continue to talk about the 4% rule, it can really be damaging to people, because if you have $1 million and you're drawing $40,000 a year, that may or may not be the right thing for you. And you'll never know until perhaps it's too late, or if you're lucky enough to have something left over. So we're going to talk a lot about that on July 28th at 6:30. Today, we're going to talk about, for planning, we're going to go through, as we always do, we're going to talk about some market activity. I'm going to start with an Ed Slott update. I'm going to talk about the markets over the past week, and then I'm going to talk about a planning topic. And today's topic, as I said, is going to be life insurance and financial planning. And I am going to refer to this Look Before You Alert book because I think it's a really nice, easy, it's only, looks like 70, 80 pages. And it's a really easy read. And very helpful. It's just a great guide. I keep one of my own that I reference often. When I was looking through it this morning, preparing for this, I said to myself, it's time to read this again. So I'll probably read that over the holiday. You can probably read the whole book in an hour. But like I said, I have maybe, it looks like 5 copies, and I'm happy to send them out if you promise you're going to read them. Okay, so the first thing is the Ed Slott update. So today's update, or this week's update, was talking about excess IRA contribution. So I have this going on for a client right now, and so this is timely. So this is written by Andy Ives, and Andy's one of the analysts for the Ed Slott group. Because remember, the Ed Slott Elite Advisor group, I'm a Master Elite Advisor. In the Master Elite Advisor group, it's not just Ed, right? It's not just Ed's expertise, and Ed's got a lot that he brings to the table. He is the IRA expert, no doubt, but it's also his people. Andy is someone I talk to. Ian, I talk to a lot, and Sarah is my Sarah Brenner, her name is, and she's an attorney. She's really my go-to person in the Ed Slott group, and she's really wonderful, very knowledgeable. So that's just a few. There's some other experts that they have that are really helpful. So the question in this, the issue posed in this is an IRA owner can contribute only so much to a traditional and/or Roth IRA annually. We know that. The IRA owner must also have earned income to be eligible to make a contribution. So I get this question a lot. Can I make a contribution to an IRA if I'm retired? It used to be that you couldn't make a contribution to a traditional IRA after the age of 70 and a half, but now that had to do with the required minimum distributions, but now that's been changed. You can make contributions, but you must have earned income. You can't just take, if you're over 50, $7,000 and put it into an IRA if you don't have earned income. Now, if your spouse has earned income, then you can make a contribution under a spousal contribution, and that's for a Roth or a traditional IRA. There are income limitations, of course, right? You can't make too much money, or the deductibility of the IRA becomes in effect. So you can still make a non-deductible contribution to an IRA. But there's a phase out in the Roth IRA. And we talked about that before. I went over Roth IRAs a few weeks ago. The Roth IRA phase outs are for 2021 are from $198,000 to $208,000 for married filing jointly, and $125,000, $140 for single filers. So that's an important point of this, because what if, and here's the example of my client, he made a Roth contribution in the early part of the year last year, not realizing that he was going to have a buyout opportunity at his employer. So the employer gave him a lump sum amount by the end of the year, and that took him over the phase out level. He's a single filer, so it took him over that phase out level. So now he has an over contribution to a Roth IRA. So what do you do about that? Well, we can't recharacterize a Roth conversion, but we can still recharacterize a Roth contribution. So in this case, this individual has until October 15th of the year following the year he made the contribution, so it's October 15th of this year, to undo that contribution. So it's not, it's a bit of a calculation. Your custodian and accountant can help you with that, but you basically have to pull out the funds and the earnings um, and undo any of that. Now, what if you don't? Well, you're penalized, right? So it's a 6% penalty in the excess amount for every year it remains. So there's a discussion in this letter about kind of gaming that system where if you're, Ian talks about, well, what if you had some annual returns of 20 to 30%, you're actually making out better? Well, Ian, respectfully, I would say to you, let's not be too aggressive here. 20 to 30% is really outrageous as far as expected returns. He actually references, 6% being a conservative allocation, and I would disagree with that. So I would say that is a more of a moderate projection. And really, you're happy if you do much more than that. But I like to, you people know me, I like to plan on much more conservative level. So I don't agree with gaming that, but it is important to know that you can undo it. So you've got to withdraw the contribution you make, and then you have to withdraw the excess contribution plus any net income attributable. So that's NIA. There will be taxes due on the NIA, so any earnings, and a 10% withdrawal penalty on those earnings if the IRA owner is under 59.5. So if you're over 59.5, you don't have the excise, but you do have to pay tax on those earnings that shouldn't have otherwise been there. I hope that makes sense. So that's kind of the gist of this letter from this slot group. It gives an example of that, but I think that's always good to review those things. So it's not the end of the world if you do make an over contribution. If you're not eligible for a tax deduction on your IRA, you can make a non-deductible contribution on your IRA. Many people will make a non-deductible contribution to an IRA and then immediately convert it to a Roth IRA. That's called a backdoor Roth conversion, or backdoor Roth contribution. And that's a fine strategy, but you have to be careful of what we call the pro rata rule, and that gets really kind of complicated. So if you already have funds in an IRA, it makes that strategy not impossible, but very inefficient. So if you're considering that, please reach out to me, because that's a big topic of conversation, a longer conversation, I should say. So let's talk about now the markets over the past week. So I'm just going to make this a little larger. So this is ending May 21st. So as of Friday afternoon, yesterday was a pretty roaring day in the markets, and today, at first, I'm looking at the TV screen. At first, the markets were up, and they took a little bit of a dip. NASDAQ is up slightly as of right now, but who knows by the end of the day. So the Dow was down slightly last week, 0.43%. The S&P 500 was down about 0.39%. The NASDAQ was just about higher. And some of the other indices around the globe were slightly positive, 1.75, 0.40. Still year to date, we have strong returns. The Dow Jones is 12.61. S&P 500 is 11.28. And from year over year, so May 21st last year to May 21st this year, Dow Jones Industrial Average 42%. The S&P 500 is 43%. Now, these are big numbers, but remember, we're in a trough at that point, and we're just starting to climb out of it. So we had a drop, and now a fast return. Remember the V-shaped return we're talking about. So that was really a gift and really helpful. And you heard me talk about that many times. The interest rates fell just a smidge last week. So the 10-year Treasury went from 1.63 to 1.62. So that's pretty stable, obviously. So hopefully we see some stabilization in the interest rate market. And actually mortgage rates are down a bit. So if you're still considering refinancing a mortgage, it may be a time to look at that. From MFS, we get some, we got about 4 different, maybe 5 different interesting points. And we talked about the last quarter for long-term treasuries. So they define long-term treasuries as maturing in at least 10 years. Boy, I would call that an intermediate type of treasury still, but maybe 7 to 9 is really intermediate, but calling 10 long-term, I don't know if I agree with that, but that's okay. I'm not going to argue with them about it. But long-term treasuries, MFS says maturing at least 10 years, fell by 13.5% in the first quarter of 2021. Now I'm bringing this up because remember, these are bonds, U.S. Treasuries. People say that, geez, I'm going to move my money when I get close to retired from stocks to bonds. Well, the first quarter of the year, US Treasuries maturing in at least 10 years fell 13.5%. Wow. How do you feel about that? How do you feel about allocating things to bonds, thinking you're going to be much more safe, and suddenly we see a drop like that? This is the worst quarterly performance for this asset group in 41 years. So this is the problem with some of these long-running issues. I'm dealing with it right now as a school board director. You've heard me complain and talk about my time on the school board. Right now, we have what I think is a financial crisis really in our district, and we're seeing in other districts around us, but I can really only speak to our district. And the projections that we have show us as a district running completely out of money by 2026. Now, that's better than it was a couple months ago. It showed 2023 and then 2024, because we made some budget cuts last year that actually we ended up with a significant surplus at the end of the year due to, COVID really. And because we didn't have kids in class, we weren't transporting, we got some salary concessions, significant salary concessions from our staff, $3 to $5 million. But what's happening is that people are looking at that. Some board members, our administration, even some public are saying, well, geez, we've been running a deficit every year for the past 10 years, and it's always worked out okay. Well, the problem is that we've had unprecedented growth for the past 11 years. The bond market has had unprecedented growth for the past 41 years. So this idea that, well, it's always going to be okay, bonds are going to correct, they're going to recover, it's always going to be okay, our budgets are going to come out ahead of what we're projecting. That is a really failed way of looking at things, in my opinion, because we can't always count when we have things outside of normal economic cycles. We can't always count on it continuing that way. Let's be happy when it does. Let's be thankful when things grow more than we were planning on. But let's plan accordingly. Let's plan. I don't even want to say conservatively, but let's plan appropriately. And what I think planning appropriately means is let's plan for a normal market cycle. Let's plan for a normal average return. Go back to Ian for a second. Now, Ian's talking about what if you have 20, 30% returns? Well, that, as a financial planner, I'm certain Ian would have never said to his clients, well, listen, we did, the S&P 500 to 30% last year. Let's track that for the next 10 years and see where it gets you. That's irresponsible, and counting on the same type of bond returns we've had for the last 41 years, and counting on the same type of budget returns we've had for the last 10, 11 years is irresponsible, in my opinion. Take Council Rock. That is a microcosm, right? Just a small look at what governments are doing all over the country, including our federal government. Our federal government still operates at a deficit. We haven't had a balanced budget since I think it was 2013. So that is problematic. And that is one of my concerns as a whole, as the economy. All right, I'm not going to go off my soapbox there. So beware of bonds. And how do you automatically get put into bonds and you may not know it? Those age dated or oh goodness gracious, what do they call this? The age-based funds, right? So you pick your Vanguard 2040 fund or 2020 fund. Well, it's already 2020. Your Vanguard 2030 fund, 2040 fund, where they automatically make those adjustments. Just be aware of that, because you might end up with a significant bond portfolio that is giving you exposure to risk that you might not be comfortable with. The answer is in stocks. Sometimes it's cash, sometimes it's dividend. Sometimes, there's a whole issue right now, and I've told you that's an area that I'm working very hard with. I actually scheduled a call this morning with a money manager to discuss ways that we can add different things to our portfolios that aren't bonds, typical bonds, that will protect principal, give us some income, and give us some stability. All right, moving on. So pent-up demand. U.S. consumers purchased $234.4 billion of foreign imports in March 2021, the largest monthly total recorded in U.S. history. So everybody, the doors are open, the sun is shining, we're getting out of this pandemic, and now let's go out there and spend money. We're seeing it all over, right? So cars can't be produced or can't be delivered. There's a shortage of cars. I was talking to a client yesterday who's got to get a new roof, and he said that the roofer is now quoting something like $110 a sheet of plywood. That's outrageous. So we're just seeing this all over. The low point for the purchase of foreign imports during the pandemic was 166.5 billion in May of 2020. So obviously a significant jump. And then inflation using consumer price index was up 4.2%. We talked about this last week on a trailing one-year basis through 4/30/2021. The last calendar year that reported inflation of at least 4.2% was 1990, when inflation advanced 6.1. We're going to talk a little bit more about inflation when we talk about the First Trust analysis, which is very good. And that in 1990, that inflation advanced 0.61%. There's an interesting bit about, and this is no political commentary here, but the House of Representatives subcommittee met last Wednesday to discuss reforming the tax code's advantageous treatment of the wealthy. In quotes, the top 1% of U.S. taxpayers for the year 2018 reported at least $540,009 of adjusted gross income. They received 21% of all adjusted gross income nationwide, and they paid 40% of all federal income taxes that were collected for that tax year. So 21% of the income came to that of all adjusted gross income nationwide, and those taxpayers paid 40% of the federal income tax. So it's going to be interesting to see what Congress comes up with as a balance for that. Again, no political commentary there. Now, gas, we know the gas prices are going up too. We're a road trip family. We have 3 excursions planned for the summer I'm very excited about, and they all include lots of driving. The average price of a gallon of gasoline reached $3.04 last Friday. That's Friday, May 14th, up 79 cents a gallon year to date. The last time gasoline closed a calendar year above $3 a gallon was 2013. So really interesting information. Okay, I'm going to skip BlackRock. BlackRock's talking about geopolitical risk. So basically their discussion in their report this week was, we've talked a lot about inflation. Everybody's talking about inflation. Nobody's talking about geopolitical risk really since the new administration has come on. BlackRock is saying it's really worth watching these specific risks, as flare-ups can catch investors off guard. So everybody kind of knows that gas is going to be more, building materials are going to be more at this point, food is going to be more. We're going to see pretty high inflation. And again, we're going to talk about what the real effect of this inflation is. It's just an adjustment from last year, but BlackRock is saying, watch out for something else. Geopolitical risk is also still out there. And because we're not paying attention to it, when that flares up, we can see significant drops in the market. I don't know if there's, again, not a political commentary, but I think that I don't know how many people would say that there's a lot of faith in effectiveness and the ability to get things done in Washington, whether you're talking about the executive level or the judicial level or legislative level. So that's not a knock on one part or the other. I think it's been like that for some time. So if something happens around the globe, we could really see a fast adjustment in markets, and again, something to watch out for. Okay, First Trust wins this week for a great report, and this is a report that is for financial professionals only, so I can't share it, but this comes from Brian Westbury and Robert Stein, both from First Trust. And they talked a lot about the Consumer Price Index and the Personal Consumption Expenditures Index, which is something that's not talked about a lot. So yeah, I'm going to read this paragraph to you. In April, the Consumer Price Index was up 4.2%. We just talked about that from a year ago. Producer prices were up 6.2%. We talked about that as well. The core measures for each of these indexes are running at 3% and 4% respectively. The Federal Reserve focuses on the inflation measure for personal consumption expenditures, which should be up about 3.4% versus a year ago. Once we get the April data, which is scheduled to arrive this Friday. So they're saying the Fed looks at something different. And I pulled up the difference for you. I'll share this quickly. And you'll see that they tend to track pretty closely. All right, so you'll see 2 lines here. So the Consumer Price Index, CPI, that's what we hear about all the time. And that's what I reported to you from the Bureau of Labor Statistics last week. what they're saying is the Federal Reserve follows this PCE index, and you'll see that they track pretty closely. There's a bit of a spread here. So it may be that we're seeing significantly lower PCE over CPI, but what we really want to look at is the difference PCE 2020, PCE 2021, because they look at year over year. So you can look at this yourself. This comes from the Cleveland Fed. This was just the first Fed that came up, but you can see, I would say these track pretty closely over the years. So it's going back to 2000. Sometimes there's a bit of divergence here, but and this is, just another look at it. But this is good information if you're so inclined to read this. Again, you could just look up CPI versus PCE. So let me stop my share there. I just want to share that with you. So they're talking about the Fed, and how they're seeing this rise of inflation. It's been concerning to me. I think that I think it's likely to continue over some time. I shared with you that I had an electrician doing some work here a few weeks ago, and he said that his supplier told him that they expected to see prices increase for the next 5 years. So I don't know if they can continue increasing like they have, because that's just, at some point it's got to slow down or just stop construction, because at $100 a sheet of plywood, who can afford to put a roof on unless your roof is completely caved in? But the first trust rates here, clearly the Fed is dismissing the surge in inflation this year. The Fed forecasts show that it expects inflation to fall back to 2%. That's its target in 2022 and beyond. So that would be really great, but I'm not sure how accurate that'll work out to be. Now, listen, there are people that sit on the Federal Reserve Board that are much smarter than I am. So we'll see what happens. But just from everything I'm hearing out there in the real world, that's not where I see it going. Then they further write, we would love to see the Fed be right about this, but this is not the first time in history the Fed has dismissed an increase in inflation as temporary or unworthy of serious policy attention. The Fed sat back and watched as inflation crept upward in the 60s and 70s. Well, that's a pretty aggressive comparison, because inflation was horrible in the 60s and 70s, as many of you know. They blamed OPEC, the value of the dollar, and a stream of one-off events for temporary lifting prices. The Fed also thought the persistent unemployment needed to be fixed with more money printing. Now, I'd like to think that we're a little smarter now. We've learned from those mistakes. You'll see that many states now, including Pennsylvania, have, I know in Pennsylvania, starting in July, now you have to attest that you've been looking for work to continue to get unemployment. Prior to that, over the past year, you didn't even have to say that you were looking for work. You just received your unemployment plus a generous amount on top of that. So the hope is to get more people out into the workforce again, because we all hear the stories about restaurants now that they're able to be open, or will be after May 31st, fully, that they can't find people to work there. I hear that everywhere. Knock on wood, we'd be very thankful with our staff, very lucky. But it's not like that everywhere. The problem is that a lot of inflation always starts with a little bit of inflation. I like that. The problem is that a lot of inflation always starts with a little bit of inflation. And once the Fed gets into the habit of blaming it on transitory events, it runs a risk of becoming more a long-term issue. And I have to tell you, going back to what I see on the school board, that's what I've said is, you folks are planning to run this district completely out of money. And what's going to happen in future boards is they're going to blame it on us, or they're going to blame it on some other kind of events. Well, we're in a recession. The housing market has fallen. Whatever, there's going to be a blame that isn't going to be theirs. And in some respect, they're right, because it is our fault as a board. I've been pushing to have some reasonable and responsible financial planning, but the majority of the board is not there. So I'm only one vote, and unfortunately, there's not enough of us to change that right now. So, but it's still going to be the board that's going to be making these potentially detrimental mistakes that some future board's going to blame, rightfully so. And again, that's happening all over, and it could certainly happen with the Fed. So what's the answer to all of this? This is a little bit, I know it feels a little bit of doom and gloom, but we could be in, there's plenty of people who say that we're going to have lots of growth. I'm kind of of the idea that we want to position ourselves for growth. Growth is kind of easy. As long as we're allocated the right way, as long as we have the right components, we're going to pick up the growth. Are we going to get every nickel of a 30% increase? Absolutely not. So the growth will come as long as we're invested. It's the risks where a lot of my focus is, because if we have sharp drop-offs, it can be very, very difficult to recover when you're beginning to draw money in retirement. So the large percentage of my clients come to me right before or just starting retirement. And this is a critical time. You've all heard me talk about sequence of return risk, and that is when you're taking money out of your portfolio and your portfolios are going down. So we certainly structure portfolios for growth, but we want to be laser focused on risks. So what's the answer? Of course, proper asset allocation, making sure that your investments are allocated in your pie chart with the best components that they can be. Principal protection, making sure a portion of your assets are protected against loss so you can't go below zero. And of course, account segmentation. So most people do the first. Some people do the first and the second, asset allocation, principal protection. Few people do the account segmentation. It's a tremendous amount of work. It's taken me 6 to 8 months just to train Emily to do steps 1, 2, and now we're heading on 3 of account segmentation. And then it's a different process for clients. It's a different process for money managers and advisors. So, but it helps work. So account segmentation, just as a reminder, is you have a certain account for every portion of your life, the first 1 to 3 years, if that's your segment, first next 4 to 6 or 7 years, next 8 to 12 years. So it breaks down like that. And you've got an account set up just for that. That helps make sure that we're going to be able to fund what we need to fund without a lot of market risk, and to be able to also have the growth that we want by investing in the long term with long-term assets. I learned it in my pension days. It was called asset liability matching. And over the years, I've continued to study it to where I think we've got it working pretty well. Okay. So in the few minutes I have left, I'm going to talk about using life insurance and financial planning. So let me just go back to questions real quick. And this took a little bit longer than I would have liked, but we may run over just a couple minutes. So Kathy asked, can you repeat the dates for the webinars, the upcoming webinars? And of course I can. So the upcoming webinars are June 9th. That's using annuities and retirement planning and Roth conversions. June 30th, that's fiduciary assistance for powers of attorney, trustees, and executors. July 21st, that is investment fundamentals. And July 28th is the reality of the 4% rule. Now, they should all be Wednesdays. If they're not, for some reason, if my brain was fuzzy or something like that when I chose those dates, I'll make an adjustment, but that they should be the dates. And they should all start at 6:30. And Kathy also said she agrees. The alert book is full of great info. Appreciate it receiving and learning from it, especially in conjunction with working on our financial planning. Well, thank you, Kathy. You did a great job with all your research for sure. All right, so I'm going to jump into with the short time I have left, and I'm afraid I'm not going to be able to give this the time that it deserves. I'm going to share life insurance, using life insurance and financial planning. So you should see my whiteboard in front of you. Please raise your hand if you see my whiteboard. Yes, thank you. All right, now, as I always say, you're going to see me looking down as I do this, just because it's easier for me to draw on my whiteboard. So remember your buckets. We have 3. We have taxable, tax deferred, tax advantaged, or sometimes tax-free, we call it. So we're going to focus on this area here. And the last time we talked about Roth a couple weeks ago, the only other thing, so there are 2 things that are truly tax-free, and that's free of federal tax, state tax, capital gains tax, and do not cause your Social Security to be taxed. And that is Roth and cash value life insurance, or as David McKnight and some others refer to it, life insurance retirement plan. So it could be either or. So how does this work and what's the value here? Well, In an ideal situation, you have um, more money than you need in your taxable bucket. So you should have 6 months to 1 year in this taxable bucket, because if you have more than you need in that bucket, you are going to each year spin off tax in the form of dividends, short-term capital gains, long-term capital gains, interest, and all these tax, all this here that you get 1099s for, they're going to force out tax, and it's going to create problems for you down the line. It can cause your Social Security to be taxed if you don't have pension. It can drive up your overall tax over time. So if you have more money than you need in this bucket, many people see the value in diverting it, and they divert it to a cash value life insurance policy. Now, some people also, if they don't have a significant amount of money in here, but they also have money in the tax deferred IRAs, 401ks, some people see the value in taking that money, some of that money, and putting it into cash value also. It's very similar to a Roth IRA in that the money, once you put it in here, grows tax-free. And if you structure it correctly, it won't be taxed on distribution. But there are some added benefits to a Roth IRA that cause some people to say, you know what, I'll go ahead and fund that out of my IRA. But the best situation is to fund it from your non-IRA, right? So from your taxable funds. So with cash value life insurance policies, there's a couple of things. There's whole life, and whole life just pays a percentage. They're going to say it's a dividend. So the whole life company is going to say we're going to pay you a dividend every year, and that could be anywhere from 2 to 6%. And then there's variable universal life. That's a V. And a variable universal life, you have sub accounts. So they're mutual funds within your policy here, and they grow. They can grow or they can fall, right? So just like you're investing in the markets and mutual funds, they can be up 10% one year, down 10% another year. So that's variable universal life. So let's just say that your span could be -10, to +10. And it could be higher and it could be lower, but let's just use that as an example. Then you have guaranteed universal life. So guaranteed universal life is really just like a lifelong term policy. They just guarantee that the policy is going to be there as long as you pay your premiums for the rest of your life. And it's not like a term policy where you pay small premiums and then they jump up significantly. It's just, this is your premium for as long as you're alive. So let's just call this lifetime term. Then there's an indexed universal life. So this is the one that I prefer. And there's a couple different carriers. And this is an important point with carriers. I'm going to talk about some issues that you should pay attention to, and they come right out of the Look Before You Learn book. But we've made a shift in carriers. So I'm being compliance minded right now. So I'm not going to mention the name, but we used a carrier for many years because they had great investment options, some very good provisions we're going to talk about, and it's a strong carrier. But we've really been struggling with underwriting. So it's no good to have a strong carrier with all these good provisions if we just can't get people insured through them. And it's not necessarily because of the people's health. It's often over the past almost 6 or 7 months, it's been because of their underwriting process, not because of what the clients that are coming to us. So we actually have been working on, and we found a new carrier that fits all those parameters that we need, and the underwriting appears to be much better. So from time to time, you have to pivot, and it's really important to know what to look for, because you name how many different carriers are out there. There's just, I don't even know, there's hundreds, right? So the Index Universal Life, away from carriers is the platform that we like to use. So what is different about an Indexed Universal Life? Well, let's go back to this bucket. I told you about whole life. Whole life pays a dividend, a stated dividend. Now, the funny thing about whole life for me is if the whole life company says we're going to pay you a 5% dividend and you have $100,000 in your cash value, well, you would think that you're going to get credit $5,000 for that year, but that's not how it works. And I've questioned that before, and I said, well, wait a minute, my client got credit $4,200, not and the stated dividend was $5,000. And they'll say, well, it has to do with this calculation, this calculation, this calculation. So it's this crazy black box calculation that honestly, I can never make head nor tails of. Just know that often my clients didn't get what the stated dividend was. And while it's acceptable for the policy, I don't like the gray kind of area or not understanding how that's broken down. And maybe that's a fault of mine, but I haven't found anybody that can really explain it 100% to my comfort level, and to where clients would feel comfortable with it. Let's put it that way. So not that it's bad. It's just a stated dividend, and it's not guaranteed, right? Those dividends can adjust, and most companies have cut dividends, some have not, but that's something to look at if you're considering whole life. The variable universal life for me is too much risk. I like to use a life insurance policy for some level of protection, right? Whether that protection is investment protection, lifetime protection, life protection, and long-term care protection. So you want that basic protection in there. So an indexed universal life, when you put funds, let's grab these funds from up here, and let's say you're going to put $20,000 a year into this times 7 years. I like to fund these for a finite period of time. I don't like to fund them for the rest of your life, because you're going to want to use that cash for other things. So let's get it in there and let's get it running and fund it as quickly as possible. There are some tax guidelines that don't let us put too much in too fast, but we determine how much we want to put in there. I had a client who said, I want to put $300,000 into this policy. Tell me the best way to do it. So we figured out how to do it over I think we did 7 years for her, and we funded that policy. Now, that $300,000 that she puts in over that 7 years is going to grow in here. The first thing is they cannot lose money via investment returns. The worst that she can do in this is 0. Some companies, the worst that anyone can do is 1%. You'll at least get 1, and then you could be capped out at a higher level. So you put the money in here, you can't do worse than 0. There are some expenses that could draw down your cash value, but from an investment return point of view, you can't do any worse than 0. And you could grow it. So you could, let's just say somewhere between 5.5, that's 5.5 to 10%. So we've certainly had clients who have done 10%. I had one client at 16.5% the year before last. We have one company has a lock-in feature, and we had people locking in at 9, 10, 11% over the past year. So it certainly can be achieved. And all of this technically grows tax deferred. Now, if it's structured right, of course, when you pass, let's just say this is a $500,000 policy. When you pass, this goes to your heirs tax-free. So unless you structure it the wrong way in a will or and it triggers some kind of federal tax for estate tax, this will go tax-free to your heirs, and it should go pretty darn immediately because you're going to name beneficiaries of this. So $500,000 will go tax-free, and that's in year 1, by the way. You put in $20,000, and if God forbid you pass in year 1, $500,000 goes to your heirs. Well, if you put in, in this case, it's $140,000 over their 7 years, and this grows to $150,000 in cash value. Well, now you've got $500,000 in death benefit. If you'd like to, let's just say after year 11 or year 10, so let's say year 10, you might be able to start drawing and say, let's just call it $20,000, just as an example, $20,000 a year. And you take this as a loan. There are loan provisions, and we're going to talk about this. And we're a little over on this, but just hang with me if you can. So there's loan provisions. You take these as a loan, and because it's a loan, it's tax-free. If I loan each of you $20,000 a year, you don't pay tax on that. It's a loan. And basically, the life insurance company is loaning the money off of your cash value. It's going to decrease this death benefit, right? So maybe after that $20,000 loan, this comes, you have 400 and, let's just call it $475,000 left in your, and that's just an example, in your death benefit. It's also going to decrease your cash value. But we test these out to go to typically 120 years old using an assumed rate of return. And loan provisions is one of the things that you want to look out for, because you want to get at least a 0% loan. So how do you do a 0% loan? Well, if they credit you 3%, if their guaranteed credit is say 3%, and then their loan interest, because they have to charge you interest, is 3%, then that's a wash, right? So they credit you 3 and they charge you 3, so you don't pay anything for that loan. So that's one of the first things you want to look out for, is the loan provisions, or one of the things you want to look out for. So you can use this as an income stream in retirement. So if you were taking $20,000 a year in retirement and you were paying 0 tax, well, that's going to help your overall tax situation, because as you've seen me do, if you convert your money to a Roth IRA, and let's say you end up with $1 million here into your Roth IRA, anything that you take out of here is 0 tax. Well, if this is structured correctly, anything you take out of here is 0 tax as well. So that helps you get to the lowest tax bracket you can, or ideally the 0 tax bracket. So this is another tool, right? This is just a tool in that toolbox of yours, and it should not be dismissed. So that's one way. So you take the loan. You take the loan of $20,000 in this example. It's different for everybody, of course. You've got to be approved for these things. And then the other thing. So this is one way money comes out tax-free as long as it's set up correctly. The other way is this is potentially tax-free as long as this is set up correctly. And then one of the benefits here is long-term care. So many companies now offer some kind of long-term care, chronic illness rider with these life insurance policies, because they recognize that long-term care is one of the biggest risks to retirees today in our country. So all these things do is allow you to take this death benefit, or a portion of the death benefit, prior to you dying. You don't have to die to benefit from it. So typically, if you can't do 2 out of the 6 activities of daily living, we've talked about what those are before, then you can have access to these funds, or a portion of these funds. So it's typically paid out over time, over 3 to 5 years, until it's drawn down, or until you don't need the funds anymore. Chronic illness, it's supposed to be, it's required to be a permanent situation. A long-term care rider can be temporary. The difference between the long-term care rider is they typically charge a fee every single year. A chronic illness type of rider, there is no fee, but they use a discounting. So instead of having $500,000 available off of this death benefit, you might have, let's say, $450,000 available for long-term care. And this is dependent on age and the contract. So you got to pay attention to that as well. So you can see how this, using life insurance, can help a couple different areas in your plan. It helps with tax efficiency, potentially, right? These funds come out tax-free. Of course, long-term care comes out tax-free. It helps with investment protection, helps with that life protection, helps long-term care protection. So that's why they can make a lot of sense. And that's how they play into your financial plan. And these should be reviewed how often? Say it with me, every single year. Because it's important for you to remember, first of all, why you went through the process of getting a life insurance policy and why you're paying. Listen, this is $20,000 a year, but there are plenty of people paying 40, 60, $100,000 a year to fund these things. I recently talked to a fella in Virginia who had about $3 million sitting in this bucket here. And there's only so much he can do with that to be tax efficient. But one thing that he can do is fund a cash value life insurance policies, because there's no limits of what you can put in there. So if he wanted to put $300,000 a year for the next 10 years, he could do that, or some version of that. He could do over 7 years and adjust that. The difference comes, he gets a much higher death benefit, because that's the formula that the IRS uses. But the secret is here, you must be approved, right? Anybody can do a Roth IRA. if you have a traditional IRA, you can convert the money to a Roth IRA to pay the tax. Here, there's something standing in between you and this, and that's an approval. So if you have any desire to get one of these things done, go start the approval process, because it can be long, it can be tedious, and it can be an absolute pain in the bleep. It depends on the companies and how aggressive they are in underwriting. Sometimes that makes a big difference, but you can't just focus it on the people who are wanting your business the most. There are other provisions you've got to pay attention to, and this is where I'm going to go to the Look Before You Learn book for the last few minutes. So there's a really great chapter in here, section, I should say, and it starts, it's chapter 6, and there are the handful of provisions here. And the first is guaranteed zero interest loans. We talked about that. So again, David McKnight's Look Before You Learn book, you can get it on Amazon, or I've got a few copies I can send. Caps on variable loan interest rate charges. So if there's a variable loan, we want to make sure we understand what the interest rate charges are, and that there are caps on those charges, so that you don't run into a situation where you're taking these loans here and suddenly the interest is out of control. And because that could really cripple the entire plan. Interest in arrears. So the best situation is you're charged interest in arrears when you take a loan. So at the end of the year, instead of interest in advance at the beginning of the year. So just think about that. If you're charged 3% interest, would you rather that come off at the beginning of the year or at the end of the year? You'd want it to come off at the end of the year. Is that a deal breaker for me? Not really, in comparison to many other things, but it is something to pay attention to. Number 4 is a stable index cap rate. Now, I didn't talk about that. I talked about the floor of 0%, or sometimes it's 1%. And you could choose a stable, 4% in some policies, but let's choose 0 or 1%. Well, the trade-off on that bucket, let's just make this a little easier to understand. Remember this bucket. So you got a 0 or a 1% floor. And the most you can do in any given year, if you're at a cap, well, that could be 6%. It could be 5%, depending on the company. So think of it like a collar, right? So worst you can do is 0 or 1. And the most you can do is, let's say, as an example, 6. So your return is going to be somewhere in between here. So that is a stable index cap rate. So you can see that if you ask for the history of the performance of the platform. Then there are also participation rates. Now, I like to go to these participation rates. So our participation rate might be, let's use the S&P 500 as an example index. And it might have a participation rate of 100% up to a cap, or sometimes it's just 100%. Sometimes it's 80%. So Mark, what the heck does that mean? Well, let's think about that. If your participation rate of the S&P 500 is 80% and the S&P 500 returns 10%, what do you get? Well, you get 8%. If the S&P 500 returns 20%, what do you get? Well, you get 16%. So typically with participation rates, you don't see a cap. Sometimes you do, but I like the participation rates right now, but it all depends. And the other thing is, this is done every year. You are kind of in this strategy for a year, and then you can change the next year on your anniversary date or around your anniversary date. And the investment options can change. They've been improving over the past few years. These strategies are built on interest rates, believe it or not, not on projected stock returns. So you can imagine as interest rates go up, these are going to get better and a little frothier. So number 4 is a stable index cap rate. Number 5, of course, is a financially stable company. You don't want Joe's insurance company with a C rating. You want to make sure that the company has a good track record, has a good credit rating, and they're going to be there and they're well funded. Number 6 is an overloan protection rider. So that essentially just says if your cash value isn't enough to handle the loan, it's not going to lapse the contract. So it's very, very important. Daily or weekly sweeps is number 7. So daily or weekly sweeps is where the funds, I'm sorry, I just got distracted by something in the book. Daily or weekly sweeps is where you invest your money, the $20,000 a year. Now, how long does it take to get invested? With some companies, it's once a month. Some companies, it's every 6 months. So you've got to be really careful. What you want is that money invested right away as soon as possible. So daily's the best, weekly's okay, but any longer than that becomes problematic. So you need a company with a good engine who's going to be able to invest that money for you, because you don't want it sitting in something earning a nominal amount when you can be investing in that index. It's very, very important. So number 7 is daily or weekly sweeps. And that is that is all of it for that. So 7 things that you should pay attention to. There's a lot more information in this book. I know it sounds like I'm trying to sell David's book. I'm not. It's just, if you're considering a life insurance policy, or you have one already in place, take a look at this, because you should understand what you own or what you're getting into. All right, folks, it's 11 o'clock. I've talked a lot. I went about 15 minutes over. We handled a lot of information. If you want one of these books, send me an email and I'll send you one as long as I have it. And other than that, I will see you next Tuesday morning at 10 o'clock, and keep your eye out for emails for the upcoming special Wednesday webinars. I'll talk to you soon. Have a great day. Oh, and you're going to have an opportunity to schedule time with me as my calendar pops up if you would like to do so. Thank you. Have a great day. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.